With the stock market doing pretty well since the beginning of 2023, the phrase buy the dip has probably fallen out of favor a little bit. But I want to tell you, history has shown that when you buy certain companies, when their stocks are down, it's a smart time to buy, and you can do really, really well doing that. I have identified a handful of high yield dividend stocks that history has shown the best time to buy them is when the market has turned its back. I'm going to talk about those stocks right now, why they're down so much, and why I think they're perfect rebound opportunities to generate long-term wealth for investors. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool, and if you're looking for even more great stock ideas, you should go to our special link. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Check out that link. I'm going to bring up these stocks right now, and we'll talk a little bit about what they are, why they're down, and why investors should be thinking about buying them right now. I've taken this chart back to 2019, so it's before the pandemic, the big run-up we've seen more recently, and then the big sell-off that these stocks have all gone through. So what are these companies? NextEra Energy Partners, Brookfield Renewable, Clearway Energy, Atlantica Sustainable Infrastructure, companies that own, invest in, and operate renewable energy utility scale projects. Just to show you how bad it's been for these stocks since their highs back in 2020 and 2021. Clearway Energy, the best performer, maybe we should say least worst performer of these stocks, down 47%. And then you have NextEra Energy Partners down as much as 67%. Short version of what they do is they own these assets and then they sell the power on long-term contracts, usually to utilities, also commercial power buyers like factories, data center owners and operators, companies that use a ton of power and they need more of it. They want to expand the clean energy that they're buying. So they sign these long-term agreements. Now, the way these companies finance it is they take on long-term debt, finance the deals, and then the spread between the cost of capital to service the debt, small amount of operating costs to run these facilities, and what they earn back to sell the power, that margin, that's the money that they make. And the biggest thesis for investing in these businesses is dividend yield and dividend growth. I mentioned at the start that this is a focus on high yield dividend stocks, and these certainly all qualify. Even with Brookfield Renewable dividend yield, roughly 5.5% for its corporate shares, 5.8% for its publicly traded partnership shares, all the way up to almost 12% for NextEra Energy Partners. Atlantica Sustainable, also a double-digit yield at recent prices. Right there in the middle, Clearway Energy, a yield just under 7.7%. As the stock prices have come down, the yields for all of these have come up. I'm going to clean up the chart a little bit. I'm going to remove Brookfield Renewable Corporation from this for one simple reason. Brookfield Renewable Corporation and Brookfield Renewable Partners, the same equity investment. It's the same ownership of the same assets. They say pay the same per unit, per share distribution. Brookfield Renewable Corporation, it's a newer entity. So we have a longer term history with Brookfield Renewable Partners. So it cleans it up a little bit. The yield for all of those stocks has gone up substantially as the stock price has dropped. But for the most part, these have always been high yield investments. Again, yield is a big part of how investors make money with these businesses. Dividend yield can go up in more than one ways. It's not just the stock price falling. Ideally, you want the dividend yield to go up because the dividend has gone up. And as you can see, by and large, more or less, depending on the business in modest amounts, the dividends generally over the past 5 to 7 years have moved higher for these companies. Brookfield Renewable, you see a dividend cut here. This is when it spun out Brookfield Renewable. When it spun it out, it awarded Brookfield Renewable Corporation shares to its Brookfield Renewable partner owners. As a result, you combine the ownership of those two, and the dividend actually didn't fall. If shareholders kept their ownership of both of those two stocks, the dividend didn't fall in terms of total dividends paid. Clearway Energy had a little bit of a hiccup here with a bankruptcy of one of its big customers that was totally resolved with no negative impact to the business. The point is that the thesis for these over the long term is growing that dividend. This is something that I've actually acted on myself with almost all of these. I've added to my existing positions with almost all of them earlier in March. So I'm talking my own book here. This is an investment that I've made myself because I've owned a lot of these for a very long time. Added more recently because I do see the opportunity. Let's pull up one more chart here and take a look at the actual performance of these stocks. We can go back to the beginning of 2016. It gives us a pretty good period of time. And this was a bit of a low point for the stock prices for these. So it's a good starting point to show how these companies can do against the market over the long term. Now, this bright magenta is the S&P 500. So it's pretty easy to see it here. Since 2016, it's up 193%. Of course, all of these yieldcos have underperformed since then. What I wanted to highlight is, by and large, from that low point back in 2016, again, some exceptions, for the most part, these stocks generally outperformed for the bulk of that time. Now, more recently, we've seen, of course, from the run-up that we saw back in 2020, 2021, the stocks have all come down substantially from those valuations. But along the line, the market has created opportunities to add to these winners. So what's going on right now that has the stocks down so much that has created an opportunity to buy? Number one, interest rates have skyrocketed. We talk a lot about real estate on this channel, and REITs use a lot of debt to finance their properties. That's the same business model that these renewable energy yieldcos use. They take on debt mostly. Sometimes they issue stock, but a combination of stock and debt to buy and invest in these assets. Now, with interest rates having skyrocketed so much, their cost of capital has gone up a ton. That has kind of collapsed the renewable energy business in a lot of ways. Now, it's a very cyclical industry. It goes through these periods where capital allocation slows down, investment slows down. So it's normal that this kind of happens. But this one has certainly been exacerbated by the surge that we saw in interest rates over the past couple of years. As a result, a lot of investors don't think that these businesses are going to be able to generate the kind of returns going forward that they have in the past. The kind of margins, the kind of cash flows, the growth of those cash flows to fund their dividends and grow their dividends. Investors are a little more skeptical about these yieldcos' ability to do that. The other part of it is also investors, but investors looking for safer, higher yield opportunities without taking on equity risk right now. You can get better than 4% yield on cash right now. In a 10-year treasury, you can get 4% or better. Lock in that yield. Don't have to worry about risking your capital. We've seen these lose half and more of their value. You're not going to lose that when you're investing in a treasury. So there's certainly been a de-risking aspect of investors viewing these as maybe higher risk with rising interest rates, squeezing their balance sheets, reducing their ability to generate the kind of cash flows that lead to dividend growth. And in some cases, looking at you, Next Year Energy Partners, investors expecting, again, this is the one with the yield pushing 11%, investors expecting that that dividend that they're paying now is more likely to get cut than it is to get increased going forward. Why do I think I'm right and the market has it wrong? History has shown that these businesses can deliver, and also the companies themselves are highlighting how they can continue to grow. I'm going to share Next Year Energy Partners. And again, I think this is on the higher end of the risk scale. I think there is a high probability that they may have to cut their dividend. Their ability to grow their dividend, that 5 to 8% through 2026 that they're expecting, might not prove to be true. But we do know this, even with rising interest rates squeezing their books, they're expecting to generate the same amount of cash available for distribution in 2024 that they generated in 2023. And part of that is by reallocating how they're planning to grow. So they have almost a gigawatt of plans to repower existing wind assets. Instead of developing brand new assets, they're taking an asset that's already producing, the infrastructure's in place, it's plugged into the grid, and upgrading the wind turbines to increase the output of these existing facilities. So there are ways still for these businesses to generate growth. We'll take a look at Brookfield Renewable, which I think is the cream of the crop. The dividend yield is the lowest. That means the market views this as the safest. Increased its funds from operations 7% when it reported its fourth quarter results. Still, even in this higher interest rate environment, they're generating increased outflows of cash. That means it's a strong business. That means that they're set to continue to grow. The bottom line is that the tailwinds for renewables, despite what you might hear on the news, where you're consuming your news from, renewables continue to see increased demand and increased growth. Where do I think about these stocks individually? There's a big difference in the level of potential risk for each of these, and depending on what investors are looking for, one might make more sense than the other. Let's start with this. We're going to go right here at the top. Next Year Energy Partners. I think this is a risk-reward investment. Investing at these levels is a bet that management is right and that they're not going to have to cut their dividend. The market has overreacted and their debt levels are manageable, and they're going to be able to more efficiently grow managing their debt profile and generate enough cash flows to support their dividend, even grow it at the modest levels that they're saying. I'm putting that one on the higher end of the risk spectrum. On the other end of the risk spectrum, we have Brookfield Renewable. I think this is the safest of these investments, the one that is most likely to be able to grow its cash flows at the highest rates, deliver great returns for investors. Along with Brookfield Renewable, you have CWEN.A, which I think is on the lower end of the risk profile. I highlighted earlier how they did have to cut their dividend before they reaccelerated dividend growth after they worked through concerns with a bankruptcy of one of their largest customers. They've continued to diversify and reduce their exposure to that single customer. They also have two really good sponsors that are helping fund and find their pipeline of opportunities. It's Global Infrastructure Partners and Total Energies, the French energy super major. So you have really good partners at the top of the funnel, much as like with Brookfield Renewable has Brookfield Asset Management, Brookfield Corporation helping feed the top of its funnel. The last one I want to highlight here, also I think it's more on the risk reward side of things, is Atlantica Sustainable. Now, first things first, Atlantica Sustainable has been able to do a pretty good job of holding pretty steady on its cash flows. The concern with Atlantica isn't really so much with Atlantica, but with its sponsor, Algonquin Power, the Canadian utility company that has a large ownership of regulated utilities and also some renewable, unregulated businesses, including a large stake that gives it basically a controlling interest in Atlantica. The problem is that Algonquin has come on hard times over the past couple of years, and it is going through a strategic review of its entire renewables business. Of course, that's carrying over to Atlantica, whose management can't really say anything more than there is a strategic review ongoing. Here's the latest from Algonquin's most recent earnings, and what they said was that they're targeting selling their renewable business in mid-2024 and closing later this year. Now, in their press release, in their presentation, they don't directly say how this would affect Atlantica Sustainable, or even if they're specifically looking to sell off their equity stake in Atlantica Sustainable. But I think it's highly likely that they would exit their stake in Atlantica Sustainable as part of their process of moving away from the unregulated renewable energy part of their business. And that kind of puts a black cloud over the top of Atlantica. Investors don't know what to expect. Who would potentially buy that stake? How would they treat Atlantica? What would be their goals with that ownership? How would it affect Atlantica's access to a pipeline for future growth? Those are big question marks, and the market absolutely hates uncertainty. So we have that uncertainty to deal with. But I think that uncertainty that creates pessimism also creates opportunity for investors who are willing to lean in a little bit to the risk, to buy while the stock is more beaten down and there is uncertainty. Of course, the risk to that is that the buyer, their ideas and their plans for Atlantica might not align with what individual investors like you and me expect, which is a return to growth, growing the dividend over time. They may have something completely different in mind, including acquiring the business in its entirety and folding it into and consolidating it into another business. And that might not be a great outcome for investors, even at this stock price. So the point is that leans in towards risk. So sum it all up. Looking at these four stocks, if you're a little bit more on the risk end, NextEra Energy Partners and Atlantica Sustainable, there's some risk reward potential there. If you're looking for stable income, dividend growth, and a higher yield, I think CWEN.A, Brookfield Renewable should be on investors' radar.